where we put you on the map. This is Ron Costa broadcasting live from the Mapable USA studios in Las Vegas, Nevada. And folks, today we're going to talk about crowd-financed IPO. That's pretty interesting. I know you guys are going to like this. Before we get this going, let's introduce Vicki Hutchmala from the World Token Market. Vicki, how are you doing today?
I'm doing fabulous, Ron. I'm excited about this podcast because our guest, we've done podcasts with him before, but he's so exceptional in what he's doing and creative in how he goes about what he's doing and crowdfunding and SEC regulations and launching IPOs, and that is so big of a subject, and Mark is going to help us bring it down to everybody's understanding of how it works and how you can strategize in the future. I think we should just start, right into it. Let's get started.
Well, let's introduce Mark Elenowitz. Mark is the Managing Director of Digital Offering. Mark, how are you doing today?
I'm great, Ron. Thanks for you and Vicki having me here today.
Our pleasure.
It's our pleasure. Yeah, we haven't done a podcast with you in a long time, and probably because you're probably the busiest person we know on the planet.
Thank you. I think I was one of your first podcasts. It's been
absolutely.
You were.
It's
That's
been
right.
a fun road as we've grown.
Yes.
Yes, and the time flies by, and here we are. We're doing another podcast.
Well, I guess today's topic, we're going to talk about small cap IPOs and bringing back what I like to call is bringing back the small cap IPO using crowd-financed capabilities and seeing a change in the capital markets to finally allow the world of retail to participate side by side, which was always limited to institutions.
Mm-hmm.
It was always the big guys.
Yeah,
that's right. And now, right? And now we got an opportunity for everyday investors to get in on this market, and there's so much that's going on. Hey, but before we get into that, Mark, maybe we can just go into your background real quickly, because I know you've done so much. Can you just tell our audience a little bit about yourself?
Absolutely. So I've been an investment banker now for going on over 30 years, and my firm was very active originally in doing cross-border M&A and activities, bringing companies public out of the Asian market into the U.S. market. And then back in 2010, 2012, we started seeing something here called the Jobs Act. And when we looked at it, we said, wait a minute, this is a great way to modernize the way IPOs are conducted. And we started investigating and looking at what the Jobs Act meant. There was 3 areas: Title II, which was private placements; Title III, which was crowdfunding; and then there was something called Title IV that we got pretty excited about because it was a great way to basically allow Main Street to participate in public offerings and allow individual investors access to what, as I said earlier, was more of an institutional product. So I ended up getting involved, and our firm at the time, since that firm I've moved on to a new firm called Digital Offering, which was a competitor, partner, frenemy, whatever you want to describe, where we combined our efforts together, and we've now emerged as the leader in doing crowd-financed Reg.A offerings onto NASDAQ.
How exciting!
Yeah, that's really key there. Yeah, I mean, the ability to go from Reg.A to an actual IPO is really fantastic. But you talk about small cap IPOs. When people mention small cap, what does that actually mean, though? Is there a dollar figure there that they're talking about?
Yeah, I'd like to say, so small cap used to be sub 500 million, sub billion. I mean, that's really in today's market considered nano cap. What I'm talking about are companies that are looking to raise. These are earlier stage companies that go on the NASDAQ small cap market or onto the NYSE American that are looking to do capital raises in the $10 to $30 million range. And when we look at what small cap IPOs are as a whole, in 2020, 2021, we saw a very active market. At the time, we saw SPACs. We saw other types of financing instruments that were being utilized. And then 2022, we really saw an end to that the kind of the go-go years of, or go-go year really, of 2021 of doing these small cap IPOs, where transactions went from being 10, 20, $30 million deals to 2022 and 2023. These deals are now in the 4 to 6 million range. So I'm excited to say that the transactions that we've conducted are larger in nature, in that 10 to 20, and we've done the larger, or really I think the largest IPOs of this past year in that arena. But I'm also embarrassed to say that as an industry as a whole, the market has become so terrible that companies are only able to raise 4 to 6 million, 4 to 8 million, and that when I'm doing a $17 or $20 million offering, it's no longer considered to be a normal transaction. It's an out-of-the-box transaction. So I'm hoping that 2024, 2025, we start to see a better marketplace as a whole, because there's so much opportunity. These entrepreneurs are creating technology and creating new types of businesses that they need capital and capital formation in order to grow. And that's really what the Jobs Act offers these individuals, the ability now to tap a larger audience in order to get the funding they need to succeed.
Right,
well,
right.
Let me ask
You mentioned a while back about the SPACs. The SPACs raised a tremendous amount of money there for a while, and then all of a sudden that market just seemed to have died down. I don't know if that's coming back either, but yeah, I mean, you're talking some big time money here, and now, you know, let's talk about the Reg.A, Regulation A in general. You mentioned at the top of the podcast, I referenced this as a crowd financed IPO using Reg.A. So maybe we could talk about that process a little bit now.
Sure. So securities in the U.S. need to be registered or exempt. And when you think of a registered offering, what you think of is an S1 or an IPO, and that's been the norm, and that's been what's been done for decades. And it enables the company to go out and raise capital from the public, and upon price discovery and effectiveness from the SEC, the companies and the underwriter is able to do what's called a firm commitment underwriting, where they buy down the offering, sell it out to their customers, and the shares begin to trade the next morning onto the marketplace, whether it's NASDAQ or the New York Stock Exchange. And that's been the common way transactions have been done. And S1 has certain rules and regulations about what and when things can be sold, communicated to the marketplace, how that communication occurs, what can be left behind or really not left behind. And when Reg.A came out and the Jobs Act came out, and it's specifically Title IV, the Jobs Act, which is modernizing Reg.A, and the terms people use now is Reg.A plus. And what that did is it really created the ability to modernize capital formation, because they recognize that the world today operates a mile a minute. People are communicating using social media, people are communicating using their phones, and it's in an instant gratification world. When you look at S1, you need to go into a quiet period, and that doesn't really work in this modern way of communication. Reg.A allowed that ability to now communicate in a modern world. It enabled investors to be able to watch videos and be able to see webinars and other types of presentations by issuers, which, if you think about it, it allowed that investor now to travel to the site or to the warehouse or to the manufacturer of that particular widget and actually do an on-site visit virtually using videos and other types of experiences that you wouldn't be able to do in a traditional IPO. It also allowed the ability to market across all 50 states without violating state blue sky. And what we did is we looked at it and said, wait a minute, this is a great way to bring back the small cap IPO and to allow using the crowd to finance companies to now trade, and instead of using an S1, use a Form 1A as the form of registration or quasi-registration, because Reg.A is actually an exemption, and then upon closing, become what's known as a 34 Act filer, which is what the S1 company does, and the next morning trade on NASDAQ or the New York. So we did the first one ever back in 2017. It was on the New York Stock Exchange. It was a company called Myomo. We went on to do several more. Most recently, right after that, we did the Fat Brands, which, as a matter of disclosure, I currently sit on their board, and then continued on. And this past year, we've done quite a few of them, and we have over 13 slated to come out over the next several months.
Wow. That's great. Well, let me ask you this, Mark. If I'm a company, regardless of my size or my industry or whatever, and I see something about crowdfunding and raising money, how do I know it's what I should do? How do I know if my company is ready or able to do it? What's the first thing I have to consider after I want to, let me look into this and see what it is? What's the most important thing for me to think of before I even start the process?
I think the very first thing a CEO needs to do is look in the mirror and decide, is this really the path they want to take? Being a public company comes with great responsibility, not only responsibility to yourself and to your customers and to your employees, but also to the shareholders. Because you're no longer having a few investors, you're potentially having thousands of investors. So that undertaking, when you become a public company, it's in essence really running two companies, the private operating entity and now this new public company, that it's important that you understand that you need to communicate on a regular basis. You have a responsibility to report your financial earnings and quarterly statements and annual audited statements. So a lot of CEOs don't realize what they're getting into, and there's a lot of groups out there that do Reg.As and other types of crowdfunding, and they don't really give the issuer the full education. When you go public, the day you go public is when the hard work begins. A lot of people think the day you get the money is the day it ends, and that's really something that CEO needs to look at. We use Form 1A as an alternative to an S1 registration. But ultimately, the same disclosure is required to an S1 that we use in our Form 1As, meaning that the companies have to have the audited financial statements. They have to have the corporate governance in place. They have to understand that when you come public, you're going to need to continually to market your securities through doing investor relations programs and conferences and working with analysts and beating expectations, not just meeting expectations in terms of your revenue growth. The capital that's raised is the catalyst for you to grow the business. And a lot of CEOs don't realize that. So that would be the first thing I would say to them.
And then you have to figure out which Reg.A, Reg.D, Reg.CF, there's so many potential ways of crowdfunding. How do you know which one is going to work for you?
Well, I think ultimately, when you think about what financing instruments are, they're just tools in a tool belt. So your advisors, your banker, your lawyer should really sit with you and discuss what your needs and wants are. Each one of those exemptions that you just mentioned, whether it's Reg.D, which is the ability now under the Jobs Act to do general solicitation of private placements, that's when you're not ready to be a publicly reporting company, but you want to work with accredited and institutional investors. So you need to have at least a $200,000 income, $300,000 joint, or $1 million net worth in order to participate in those transactions. Reg.CF was a new, interesting way to crowdfund companies. It can be done where a non-accredited investor could come in. The company can raise up to $5 million. They need to have audited financial statements, and it needs to be done through a registered portal. But the downside to crowdfunding is that those securities are restricted for 12 months. And the reality, and I don't get involved really with crowdfunding companies, is it's great for young entrepreneurs to be able to raise capital, but for the investors, there's no real exit strategy. So unless it's a company that's going to go IPO or be taken out through a merger, I like to say crowdfunding is nothing other than a charitable donation. You're going to drink your beer, eat your bread, and at some point you're going to want to get your money back. Reg.A is it for a company that wants to trade on a national securities exchange and be able to provide liquidity to their existing investors and grow. But there are also Reg.As that are being done where they can be done for companies that aren't ready to trade yet. So we've seen a lot of companies have a tremendous amount of success raising capital from the crowd where they're able to raise up to $75 million through the filing of a Form 1A in a 12-month period, and these companies are using that capital to grow. In fact, we did one last year where we raised $18.5 million for them as a non-traded Reg.A, and we're getting ready to file in the next week a $20 million Reg.A that will trade onto NASDAQ. So they're great stepping stones. It's a great way, but each one of those capital tools could be used in various manners to allow that company to grow. And when it's an appropriate time, then they can come public as that final stepping stone into the public marketplace.
So each of those is applicable to any company. It's not like if you're in a certain industry, if you're a certain size, if you're in a certain state. Those are not really relative because anyone, anywhere can use any of these depending on what they want to accomplish.
Well, yes,
it's not restricted. Yeah?
All of those tools are available, but each tool has its own benefits and requirements. So the beauty of doing a Reg.D is you don't need audited financial statements, and you can use alternative financial statements in a PPM and risk disclosure document. Reg.CF requires audited financial statements if you're raising over a certain amount of money. But the Reg.A, non-traded Reg.A, a lot of companies utilize that where they're earlier stage in nature. But if you're using Reg.A the way we use Reg.A to be listed on a national securities exchange, you really need to be a company that's mature enough to attract investors and that understands that it's going to be the ongoing compliance costs are anywhere from $750,000 to $1 million a year. And there's responsibility as a filer that now you're a reporting issuer. So we don't work with companies that are startups or early stage for those type of listing opportunities. Ideally, you need to at least have a $150 million market cap, and that would really be on the low end to qualify for a listing. Now, in the market we've seen here recently, there's a lot of companies that have been coming public that are a lot smaller in nature, but the worst thing you can do is go public too early and then find that you're not able to afford the compliance costs. And they're all alternatives. Like the OTC markets is a great marketplace where companies that aren't quite ready to be on NASDAQ or the New York or the expense of it can find benefit by listing in that market and attract investors that have interest in those type of earlier stage opportunities.
So a lot of your success depends on who's giving you advice to do whatever it is you want to do.
I would say that's certainly a part of the path. Ultimately, the success lies in the ability of the CEO and the company to execute its business plan. But I think it's important that as companies are evaluating which path to go down to, that they do have appropriate and adequate counsel, whether it's securities counsel, an investment banker, a financial advisor, because there's a lot of companies that are being taken advantage of by individuals who might be a marketing firm and don't understand their roles and responsibilities. It's with raising money from the crowd comes great responsibility because you're not getting price discovery like you would in a traditional offering from Wall Street. So with that comes, it's more of an art than a science in order to determine valuation. And it's important that transactions are priced to sell and that they're priced in a reasonable manner based on comps and peers, that what you don't want to do is price it at the high and have it come down. And why I'm saying this is I find that with a lot of the companies that are coming to us where they've done previous rounds, they've had bankers or individuals that really didn't look towards the future. And when you don't have one institution or a large group that's setting price discovery and the CEO thinks he's worth $1 billion, and if an investor is investing $500, he might agree with that billion. When we come along and say that company maybe on a good day would be worth $40 million, it's hard for those type of companies to come public because the prices aren't going to be reflective of where the CEO previously sold the stock. It's going to be reflecting of where the market dictates it should be today.
Right.
Yeah, the CEOs, they always think that they're better than they are, I guess, a lot of times. But all these examples that you just gave us, all these are tier 2 offerings. Is that right? For the Reg.A?
Right. We only when I speak of Reg.A, tier 2, because the tier 2 allows you to raise up to $75 million. But the concept is that the disclosure documents that are required for the public offerings we're doing are to an S1 standard. They're utilizing Form 1As as their filing statements, and it's called an offering circular. But ultimately, the disclosure is almost identical.
Right. Okay. Yeah, I mean, I could definitely see the advantage of all this because obviously liquidity is something that everybody wants. And what did you mention before? Sometimes you kind of get stuck in something where you're just basically donating, and nobody wants that.
Exactly, and that's why
I'm just wondering. Yeah,
so some of the things that we're looking at, I mean, one of the reasons why I think Reg.A is attractive now to companies that are looking to come public is that, unfortunately, the new norm of the small cap IPO is what we call structured financings. So these are investor-driven transactions that have lower valuations and smaller in size. So bankers are optimistic and feel that the company might raise up to $10 million or $20 million at, let's say, a $100 million valuation or $200 million valuation. And that was how it was in the past, where the company, the banker, things were more issuer-driven. What we've seen in today's market, though, things are what I call investor-driven. So where it might have been a $200 million valuation, it's now an $80 million valuation, and the deal gets downsized from a $10 million deal to a $4 million deal. And what used to be straight common stock is now a unit offering with common warrants or pre-funded warrants or toxic convertibles or ROFRs that reset on warrants. So basically what you're having is, instead of being the true definition of a public offering that's diversified with thousands of shareholders, you're talking now, today's market is really one or two institutions with a small shareholder base of 300 or 400 to qualify for NASDAQ, and then those investors really have only 100 or 2,500 shares. The syndicate players buy them, immediately sell it, the stock gets sold down, and basically you're seeing IPOs go from $4 or $5 a share to $1 in a week. In 2 weeks, it's devastating. So I call it really the death of the small cap IPO. So what we do, and our success has been around finding transactions that don't require the use of institutions or those type of toxic structures. These are straight common stock deals. Instead of having 300 shareholders, you have 10,000 shareholders. So you have a true definition of a diversified offering where there's not any type of concentration in one investor, and it allows the company to focus on using that money to grow their business and focus on executing rather than having every day to deal with the stock prices going down and worried about how they're going to raise their next round of capital. Because what's also happened is that same client that wanted to raise 10 or 20 million that now raised 4 and is public, their opportunity to raise capital at reasonable valuations is now diminished significantly because the prices have come down. So suddenly they're diluting themselves much greater, and they don't have enough capital in order to execute their business plan.
That's a bad place to be.
On these crowd-financed IPOs then that you're speaking of, well, what is the role of, let's say, a broker-dealer or a transfer agent? They will have to have them then, right?
Well, the broker-dealer is the investment banker and the underwriter. So they're it's just like in an S1. A firm like ourselves, and there's a lot of other good firms that are out there, we come in and we underwrite and work with the company in order to facilitate the capital raise and listing onto the higher exchange. The transfer agent is important because every public company requires a transfer agent in order to maintain the books and records. But ultimately, these securities, again, it's no different at the end result that the company is listed on NASDAQ. It's the form of registration or quasi-registration exemption like a Form 1A. That disclosure documents what's different, but the ultimate benefit and the ultimate endpoint is the company's now listed, raised capital, and is able to then move forward to look towards executing their business plan and increasing shareholder value.
As long as they have the means and the value, the cash or whatever, to stay listed on these exchanges, like you mentioned before, they're quite expensive.
They're not inexpensive. So companies, going back to what Vicki said, company needs to look into the mirror and then choose which one of those 3 buckets of capital raising capability or exemptions are best for them. So we advise a lot of companies that come to us, they're not quite ready for NASDAQ. Come back to us in a year, maybe go, and we refer them on to another firm to do a crowdfunding, raise some capital there. They then go do a friends and family and institutional round, do the Reg.D. Then they might do a non-traded Reg.A where they're able to grow their business, not have the pressure of dealing with a public company, but dealing now with the ability to execute based on that crowd's money that they've raised. And then they come back to us in a year or two, and they're able then to come and raise capital with us, where they're ready to go on to a national securities exchange. So there's roles for everybody. There's what's great about Jobs Act is it enabled now entrepreneurs to have various tools in order to have capital formation that weren't previously available. It used to be reserved primarily for the elite, for the institutions, and for the accredited investors. And now Jobs Act, between Title III and Title IV, as long as you're over the age of 18, you don't invest more than 10% of your income or net worth, you now have an opportunity to participate in early stage opportunities and be able to find that diamond that maybe becomes, or that diamond in the rough that maybe becomes that next Facebook or Twitter or whatever it might be.
Kind of putting everybody in the equal position.
Levels the playing field, certainly.
Absolutely. So we're talking SEC and the Jobs Act and that's all federal regulation and what have you, but how much do you have to, or how much does state regulations impact these various crowdfunding platforms? Do they have much of an effect?
Well, certain states certainly have their state blue sky requirements and other type of filing requirements on a state-by-state basis. The one thing about Reg.A is that it's blue sky exempt, so all 50 states are available when there's a broker-dealer involved for the sale of those securities, and certainly listing on the National Securities Exchange, you're exempt. But issuers need to speak with their counsel and determine on a state-by-state basis what regulatory filings are required, and then determine on how those filings are made.
So if you're in Nevada, for example, do I have to register, or my company have to be located in Nevada in order to take advantage of these various platforms, or does it matter?
Well,
initially.
So I can't give you advice on Nevada law, but what I can tell you is that Reg.A and crowdfunding is available to North American companies. So these are companies located in the United States and Canada. There are other tools for companies that are outside the United States and other types of filing requirements that are available. But for purpose of this conversation, Reg.A is for North American companies, and certainly Nevada companies can participate, but whatever requirements in your local jurisdiction, the company would need to speak with their counsel.
Oh, okay. Very good.
Well, I'll tell you what,
Mark,
I love it. Yeah. I love this.
Nobody wants to be a lawyer. Nobody wants to be a lawyer.
But anyway, I wanted to ask you, if somebody wanted to get more information on this or wants to meet with you, et cetera, what's the best way that they would contact you, or how would they go about getting more information?
Thanks, Ron. Absolutely, you can reach out to us. We're at digitaloffering.com. You can look myself up directly. I'm on LinkedIn. And then my email is Elenowitz, spelled Elenowitz, at digitaloffering.com. And we would welcome and encourage everyone to contact us. We'd love to talk to you. If you're not quite ready for us, we're still happy to see you succeed, so we'll give you as much advice as we can in order to have you come back at a later date. We're also very active now going back on the conference circuit. We're having a conference, a webinar later this week. Today's December 4th. I don't know when this podcast is going to air, but there's going to be a webinar that we're doing with NASDAQ on December 7th, and there's an event coming up at the end of January or early February, which is a small cap conference. But if you do a little searching on the internet, you'll find information on digital offering and the offerings that we do. And certainly if you go through the SEC website, you'll be able to see some of the filings of the IPOs that we've recently conducted.
Yeah, and we'll link to your website and everything else in the show notes for sure on this. But the last thing I wanted to mention was you mentioned it earlier in the podcast how the real work starts after you get the money, and these CEOs think about, oh, I've got money now, I can just kind of like glide along, and that is certainly not the case. I heard it mentioned. Somebody told me, like, once you get the money, it's like, well, you want to go public? Do you want to have gray hair or no hair? So there's a lot of. There's a lot of stress involved there. But,
yeah, absolutely.
Yeah. But yeah, And I'm sure you see it every day with your clients. But it must be great when it actually all happens the right way, and you're listed. You've gone Reg.A. Now you're listed. You give your investors liquidity. Everybody's happy. You're making money. The company's doing great. That's the ideal situation, and that's what we all strive for, right?
Absolutely. Well, we're excited. Thank you for having us here today, or having me here today. And I look forward to continuing the conversations with you and your listeners. I think 2024 is going to be a pretty interesting year, and I'm sure there's going to be new types of capital formation techniques that come out. We'd love to come back and talk about it.
Yep.
Absolutely.
I'm sure we'll have you on. Vicki, do you have any closing comments or questions?
Well, like I said, we've had Mark on before many years ago and we were talking about blockchain. And what's exciting about Mark and what he does in his companies is, like with the Jobs Act, it came out, they saw something, they saw the potential, and they made it happen. And they made it happen to teach companies and businesses, well, this is how you can raise money and this is how you can do it right. But also being able to adapt it to what fits so that you actually can be successful. That's what I find impressive about Mark. And also, he does it right. He helps you. If it's not a good thing, he's going to tell you it's not a good thing and this is why. Or this is what you need to do, come back. It's not, there's so many businesses out there that take advantage of, I don't want to say ignorant, uneducated people who have heard some little thing that said, oh, you can do this yourself, it's real easy, but it's not, and Mark will help you through the process to be successful. And that's what makes Mark and his businesses impressive, and why every one of our listeners, if you're contemplating this, talk to Mark, because he will help you, and eventually you will be successful in your IPO, your raise, your launch, whatever crowdfunding you want to do. And why we will have Mark back again to continue the conversation, to educate our listeners, because that's what we're all about, making sure you have the right information. Not whatever you found on the internet that told you, oh, this is easy, go do it. No, that's not what we're about. We're about giving you the right information with people like Mark Elenowitz and his companies.
Well, I appreciate that, Vicki. Thank you. And
it's an absolute honor.
It's not just me, but I think any service provider that's reputable in the industry is the first stop. Things can't be done on your own. If they were, everybody would be doing it. It's always great to have good financial advisors, lawyers, accountants, and team members around you.
Absolutely.
Absolutely. All right, Mark, thanks again for being a guest on the show today. Vicki, thanks for co-hosting this episode. And folks, for listening to the Mappable USA podcast on MappableUSA.com. If you go to that website, you scroll down, you'll see all our syndication sources. Click the one you like best, subscribe, and you'll never miss another one of our episodes. If you want to be a guest on the show, like Mark was today, there's a guest tab there. Fill that out. We'll see what you can do about getting you on the show. And if you like what you heard today, send us an email at info@MappableUSA.com, or just leave a comment on whatever page you're listening to this on right now. So thanks for listening. Thanks for your support. We'll see you next time on another Mappable USA podcast. Have a great week, everyone.